What is going on, everyone? Welcome to our Finance Tuesdays. We are on part 10 of the Blueprint to Financial Freedom. Last week, we talked about why I don't use a 401k. We are getting the ideas from Jerry Fetta's book. It's called The Blueprint to Financial Freedom. Make sure you get a copy or leave a link in the description below. So today, we're going to talk about long-term care insurance. And the reason why we want to talk about this is because eventually we are going to be old, right? We're going to be elderly, and we're going to be at a point where we're no longer going to be able to take care of ourselves, and we need in-home assistance. And what people don't realize is it can be very costly. In fact, if you have somebody taking care of you, it's going to cost you $9,000 a month. That's the average cost. So imagine you have your assets and you're now using some of those assets to pay somebody to take care of you. In 3 years, that would cost you $324,000. That's a lot of money where you could actually use that money to pass down to your kids, your grandkids, your spouse, and you can make sure that you're not spending as much out of pocket. What are the alternatives to this? Well, the first one is you can self-insure, where you're already saving 40% of your income. You can already take care of your taxes and other expenses. Well, not everyone reaches this point. So what is our second option? The second option is you can get Medicaid. Well, obviously that's not where we want to be because that's where you're dirt poor. So that is now gone. The third one is you can buy long-term care insurance now. The issue with that is it's going to cost you between $300 to $500 or more per month. And it's like car insurance. If you don't need something from the policy, well, it's just a waste of money. And when you do need it, you can't change the structure of that policy. So you're stuck. You've been wasting all this money and it's put you in a tough predicament. What is the alternative to helping us with our long-term care solutions? Well, the solution is opening up another sacred account, but it's not going to be the same design. We are going to get a joint survivorship sacred account. And what we're going to do with this is we can take up to 90% from the death benefit if we need it. The great part is the policy is still going to grow at 3 to 5%. We can borrow it to make investments. And if we need that death benefit, well, it's available for us to handle those costs. The other cool part is the beneficiary is going to collect money still from that death benefit. So it benefits a lot of parties involved. So what you want to do is you want to set up this policy, make sure it's structured correctly. And again, you're going to do this after you have achieved the financial freedom. You're not going to do this while you're trying to get out of debt and get investments done. You're going to do this later down the road. And when you set this up, it's going to protect you from that long-term care cost because there's no guarantee that you'll have your spouse being able to take care of you all the way up to your debt. It's not a guarantee. So you want to protect yourself. You know, it's there just in case. See, we get insurance because we want to make sure we're protected in case of a worse situation happens. So that's why you want to plan for these things. So we set this up, we make sure we're covered. And then if we ever need it in the future, we've got the money and the investments we made, we've worked so hard for. It goes down to our kids, our grandkids, and to all our loved ones. So hope you guys enjoy this video. If you got any questions, please leave a question in the comment section. Make sure you like and subscribe to this channel. And if you want to go to the other video, why I don't believe in using a 401k, go check that out now. And I'll see you in the next one.